Welcome to Real Talk, Real Estate Discussions with Andrew Kirsh. In each episode, Andrew interviews industry leaders. We'll hear their real-time opinions on today's market, their background and unique career highlights, and guidance for newcomers into the industry. You can find this show at sklarkirsh.com and on YouTube, LinkedIn, Apple Podcasts, Spotify, Google Podcasts, and more. Now here's the host of Real Talk, Andrew Kirsh.
Episode 37 of Real Talk, where we've talked about the rise in interest rates almost on every show. It's now time to talk about the rising costs of insurance. It has gone up so drastically in the last 12 to 18 months that it is now affecting whether deals pencil, whether it's new deals or whether it's getting insurance renewed for existing deals. Clients of mine are shocked by the dramatic increase in insurance costs. So I have on today's show Michael Landa, who's the vice chairman and managing director at Marsh. He sits in Miami. He has a national practice. We have a great conversation discussing why insurance premiums are up. And is there anything that owners and his clients, my clients, can do about it? And there are certain things that Michael suggests of what property owners can do. So definitely worth a listen to Michael Landa. I hope you enjoy it.
Hello, welcome to another episode of Real Talk. I am here with my good friend Michael Landa, the vice chairman and managing director of Marsh USA. Michael, how are you?
Wonderful, Andrew. How are you doing?
I'm good. Well, I call you bi-coastal Michael because I know half your year or some part of your year you're in Miami and another part of the year you're in LA. And so where are you today?
Today I'm in Miami. We're trying to follow the weather patterns, and it's a good weather pattern here now, so it's all good.
Yeah. So avoid Miami from what, Memorial Day till Labor Day?
Pretty much, yeah. Yeah, we don't talk about it too much. It's been a great summer here. No real major issues in Southeast Florida, but the rest of the country's had some issues.
Yeah, absolutely. Well, here in LA today, it's early October, and we're having our hottest days of the year. I think it's going to get up to 85 degrees even in West LA. So summer has finally arrived in October. So, Michael, I wanted to have you on. Obviously, you're an insurance expert, and I want our audience to hear about your background and what you do for Marsh. And I know you've had your own companies, but in my 23 plus years of practice, insurance has always been an issue. But I feel like this year it's been a much bigger issue than in any year previously, from two standpoints: the cost of insurance and whether an asset is even insurable. And that has really factored in my clients' decisions as to whether to transact or not. And so that's why I wanted to bring you on. So I guess as a start, why don't you tell my audience what you do at Marsh and your background?
Yeah, my background, I've been in the business for over 30 years, primarily focusing on property and casualty. We have a very large group in particular in Florida, but we work all over the country. The primary focus is construction insurance and real estate. So the two kind of dovetail each other. When you've got a lot of these large construction projects, they tend to need the handoff and the budgeting for the long term. And both sides of the coin right now are very challenging, both construction and permanent insurance for real estate. And, there's a bunch of converging factors that's kind of driving this. But anyway, that's my background. And, again, I've been doing this for many, many years, and I've never seen it this challenging, quite frankly. We've been through a bunch of hard markets in the past. But we'll touch on a couple of reasons where I think the audience will understand a little better why we're in the predicament we're in, and hopefully there's a light at the end of the tunnel here.
Yeah, absolutely. Between rising interest rates, where the 10-year Treasury is now close to 5, I think it hit 4.8 earlier this week, and rise in insurance, it has become extremely expensive to purchase real estate. And so before we dive into market conditions, I mean, so what is your role at Marsh?
My role is we oversee a group here in the Southeast of a couple of hundred people, ranging from all facets of insurance. It could be aviation, financial institutions, construction, real estate, you name it. The insurance world has gotten so broad, from cyber liability. These are things we hadn't talked about 20 years ago. So we're overseeing that group, and then we've got various resources around the country that we tap into, which is why having the Marsh name in front of us is so key and so important. And, we do business not just in the US, but around the world. So dealing with colleagues in other parts from an M&A perspective, we do a lot of private equity work. So we're touching everything, and when I told you my background was really real estate and construction, that's just an area that's always been such a hotbed, both for Los Angeles, Miami, and in particular New York. So it kind of found us, we didn't find it. And M&A just kind of grew out of that. And although we're experiencing a slow period right now, we expect that the M&A world is going to come back very, very strong, I hope, in the next 12 to 24 months.
Yeah, no, absolutely. That's what we're all looking for. All right, so let's dive into insurance and the ability to get insurance and the cost of insurance. And a common comment from my clients is whether their insurance is up for renewal or they're buying a new property, of just how much insurance costs have gone up. I mean, it's not even double, it's magnitudes. So can you talk about this pricing dynamic?
Sure. Market conditions as a whole, just looking at it from the macro perspective, there's three big drivers, I think, that are causing these issues right now. We can touch on all three just briefly. One is climate change, which is obvious. We've had Idalia that hit the northern coast of Florida this summer. California, we've had the first tropical storm in 80 years.
Yeah.
Hurricane Lee hit New England and Canada. New York, we just had this tremendous round of flooding. Maui's got over $3 billion in losses due to wildfire. And then Ian, which was back as September of 22, a year ago here in the west coast of Florida. I think it's the deadliest storm since 1935, and it's tracking now to be north of 100 billion. So that's not helping things. Okay, just from a macro perspective, forget all of the other little things that are occurring. Then you take the interest rates that you touched on. I think the number is 11 hikes in 1 year. That's dramatic. Okay. So what's happening now is the insurance companies typically write 96, 97% what we call combined loss ratios. Those are the good ones. So every dollar that they take in, they typically pay out anywhere from 95 to 100 cents on a dollar. So where they made their money over the years, which is why the Warren Buffetts of the world are in the business, is on the float. And they invest that money and they get their returns. So now you've got alternative fixed rate securities. You can go buy a T-bill. You can put the money in last Friday with JP Morgan for 6% for a year. Why would I bother to try to underwrite insurance when I can take these fixed rate securities and have myself, guaranteed income there? So that's sort of the headwinds that we're facing. The other thing is, reinsurance, because of that, was down, I think, 16, 17% in 22, while rates went up 40 to 60% across the European, US, and Bermuda facilities. The reinsurers are the ones that really are the head of the top of the umbrella. So they're the ones that are really making this insurance world function. If there's less capacity there, the insurers don't have the ability, based on their own financial statements, to write business. So it's a push and pull, and it's been a very challenging challenging time. So typically your clients that would buy a property that might have a carrier that could put out the limits for that property, $50 million. About 2 years ago, they got cut back. So then you had 5 carriers at 10 million each. Now you've got 20 carriers at 5 million each. And each time they issue a policy, it's going to cost them more money to do that. So that's sort of the driver behind these dramatic increases. And then lastly, you've got inflation. And inflation is a major driver here because, again, I'm throwing stats at you that blow my mind because I made some notes before. I think we hit a 41-year high in inflation in 22. So you can kind of see we're setting records all over the place. But what's happening is when you have rate increases of 30, 40%, and then you've got a $30 million building that now you have to insure because the insurers are mandating it at 50 million, you're getting hit twice. You're paying the 30% increase in rate, and you're paying almost double anyway on the same rate basis because now you're insuring a $50 million building, not a $30 million building anymore. So that's sort of what's occurred. You take all of these things put together, and it makes this underwriting process from a real estate perspective very, very untenable. And again, it's labor, it's supply chain, it's material costs. All of these inflationary factors, I think, are hitting everybody.
So, I guess, how can our clients out there, when they're trying to underwrite a deal and they're expecting insurance and other costs to have a typical increase over the life of their ownership, and they're being thrown a curveball that a renewal is now 30, 40, 50%, in some cases even higher, where it really puts a challenge on their initial business plan and IRR expectations for their investors. I mean, they really have no choice. You have to have insurance. There's not a lot of options. I mean, if you're advising a client, what can they do?
Yeah. Look, the insurers have their own mandates that they're dealing with internally, which we can touch on later so I can answer your question. But I think you need to get out in front of it, okay? And some of the things we need to do now is to make sure that we get our clients to get updated appraisals immediately instead of relying on the insurance companies to mandate what they need to insure it for, because data is power. And if we can show them, look, this is what the appraisal shows, this is what the replacement cost is, it's less than you're mandating, that's one. Two, try to be responsive to the loss control recommendations that the insurance companies are telling you to do. If they're telling you to, put in certain water flow protections or roofing issues or whatever it is, depending on the cost factor and making sure that it's economically feasible. You got water flow technology issues, roofing systems. You could put storm rated windows in Florida. Little things like this, you have to look at the return on investment, but that's an alternative too. So just getting down to the basic stuff, I think, is very important. I think going back to your lenders, okay, and looking at your lender covenants, all right, and looking at what does it say? What are the cat limits? What are the retention requirements? Getting your broker to provide you with what we call a risk model, which is looking at your portfolio, and there are certain risk models out there that the insurance companies use that say, hey, 1 in 250 years, 1 in 500 years, 1 in 1,000 years, this is what we're expecting this claim to be. Use that in your discussions with your lender and say, hey, here it is. Yes, we need to insure full value of the same $30 million example, but my risk model says it's only 16 million. So I know my land underneath is worth a lot of money. Why are you making me insure more than the 16 when that's all the insurance companies are underwriting it at? So I think we need to take a very proactive position. A lot of the lenders have third-party consultants that work for them. They understand what's going on in the marketplace. We know a lot of them because of all the business we do. So we can sit with these guys and explain to them, hey, this is the reality. What's commercially available may not necessarily be commercially reasonable. And you need to work with us.
Yeah. And so when do you typically get involved? Is it on a single asset transaction? Is it a portfolio?
Typically, it's portfolios. The single asset transactions, there's not a lot of sophistication needed there, and there's not a lot of work that can be done there. You can do the risk model on that single asset, but when you start looking at different portfolios, okay, you can help in doing things like this, and advocating on behalf of the borrower. You can do blanket limits so that if you have 10 properties, and you do have a spread of risk along the state of California, or maybe in various states, you don't have to buy up to that full limit, because again, the risk model is your data analytics that'll help you, and it'll tell you, hey, you may have $1 billion portfolio, but the risk model says on any given day, your most expensive asset's $100 million. You don't even need to buy up to that, but if you want to, go ahead. But you don't need more than that, because you're not going to get 2 storms hit you on the same day. So there's ways in trying to dummy this thing down.
Yeah. Although, Michael, hold that thought. We did have in LA that hurricane, or tropical storm for the first time in 80 years, and an earthquake. I think it registered 5.0 base in Ojai the same day.
I was there.
Okay.
I was on the phone during your minor rainstorm that you called. And
it's not what I called. It's what the weather
the weather guys did.
Yeah.
And I said, I think I'm in the middle of a little earthquake here. But by the time I said it, it was over. But to your point, yes, it's somewhat rare. But then we go back to the climate change issue. I don't know what's going on, but all of these studies are kind of getting thrown out the window these days. But we're still hanging on to them and trying to refine them, and they're upgrading those. But you're right. But in theory, that is the way that we try to approach it. We try to also leverage as much as we can with the carriers, the premium dollars, because leverage is key. Trying to maintain relationships with those carriers, because even though, yes, some are coming and going in the States, and in particular, I hate to pick on California, but because the commission there has tried to suppress rates, it becomes a bit of a challenge, because a lot of those carriers are going to exit if it's an artificial suppression, as opposed to letting the free market do what it needs to do. But if you have those relationships and you're grandfathered in, many times they will, especially if they have what we call a bank, where you've paid in enough premium, where even if you have a little loss, they're still in the green with you. You have more of a discussion there. You can explain to them why your assets, and advocate why your assets are better than they know it is. And you can advocate and get away from that commoditized real estate purchase, because typically the real estate industry is a commodity buyer of insurance. And if we can position it a little differently, and there's a relationship here, I know it doesn't sound like it would be as applicable, but it does mean something to the carriers if they believe they have a relationship, in particular, starting with construction and rolling into the permanent side of things.
Have you ever seen an asset be uninsurable?
No.
There's always an insurance company or policy that you can't get. It's just a matter of price.
It could be challenging sometimes to get full limits in this environment here. And there are other alternative risk solutions that we use in order to combat that. But in theory, that's where it's not that it's not insurable. It's just, again, because of the suppression of limits and reinsurance, it's been very hard sometimes to get full limits on a particular asset. We've never had a problem, though, getting insurance on an asset. No.
Yeah. Talk about captive insurance. I mean, what's your experience with captive insurance? I mean, maybe you can even just describe what it is to my audience. It's a term that gets thrown about at certain conferences, at YPO groups. People say, "Oh, I've got captive," and a lot of people don't know what it is. Is it right for them?
A lot of people pursue captives basically to
Can you
take.
first talk about what it is, and then
Yeah, a captive is an alternative structure. It's basically setting up your own insurance company. Okay, and you can use various venues to do it. You can go offshore where the dollars remain offshore. You can do them in Vermont. You can do them in the U.S. in different places, Bermuda, Caymans. But basically, you're setting up your own insurance company to be able to take on the risk. And it satisfies whether it's a lender or in some cases, we use captives because there are certain companies, and I need to get out of real estate for a minute because the big driver there is sometimes captives are set up truly for profit as opposed to an alternative risk where it's just another alternative. And you don't necessarily have to go to a captive in order to satisfy what you need as a real estate owner. A lot of captives, and I'll give you an example. There are companies out there that retailers that are selling extended warranty products, or there are various cruise lines or airlines that are selling travel insurance. Those are very profitable businesses. So why risk party transfer that or give it to a third party when you can retain it yourself? But it does make the consumer more relaxed to know that there's a real carrier out there. So what you do is you go to that various venue, you set it up through actuaries, attorneys. You have to have captive friendly locations. You set up that insurance company. You obviously assume the cost that an insurance company might. You can also rent one, which is a whole nother discussion. And then you drive those premiums through that captive and you get reinsurance and you get a front. And a front is basically taking that A-rated carrier that would front for that captive so that to the public, it really looks like you have an insurance company that is fronting for you. And you're basically collateralizing the exposure that you have within that captive, whether it's through letters of credit or cash or wherever you fund it. So for real estate, in many times you can use a captive to self-insure that portion. You can step in, and if you have a gap somewhere between the $50 and $100 million of limits you need to buy, and that limit is hard to fill, to your point, okay, whether you can or can't get insurance, or that limit is very expensive, you can use your captive to step in and fill that gap.
Got it. So what about claims and exclusions? Have as climate change, and we're seeing all these weather events, has there been an evolution of exclusions to policies over the last couple of years, and what should people be wary for as they call their insurance broker and expect to make a claim and realize they're not covered for a certain disaster?
Well, the biggest one, of course, was COVID-19.
Sure.
Right. And you could not forecast that. So typically from what I've seen, all the courts have pretty much shot down the fact that, hey, we don't have a physical loss here. There was no physical loss. So there's no way to put a claim in for that. Okay. So you have a problem because typically what's going to trigger business interruption, which is where I think you're going, because business interruption is the driver of all of this.
Yep.
Because if you have no physical damage, how do you put a claim in, right? So those are the exclusions that are typically there. Physical damage is the key, and you have to have a peril in order to put through a claim on the physical damage side. So we use a lot of manuscript forms. We've tried to think of everything there is, but again, if you asked me 5 years ago, could you forecast COVID? Now, some of them were silent and some of them actually did pay off to a certain degree. Now, a lot of the insurance companies are certainly aware of that, and there's certain wording in there that is dealing with that. But for the most part, we haven't had any real issues. When you get to certain areas like construction, which I guess would be in the discussion here, you've got certain exposures there that are not going to be on one policy. So typically you've got, a builder's risk, which is if a hurricane or fire or something happens, the liability within that. Then you've got the workman's comp, but you've also got other areas of exposure, whether it's mold. Mold is typically going to have to be a separate policy. So you can't assume, and that's where you need to be educated, that mold is going to be part of your property claim, right? So there are certain exposures that you have to insure separately: environmental, mold specific. On construction, you could have design defects. That's going to be a separate policy. So the broker has to just educate the buyer or the developer or the owner where the gaps are and what is available and whether they want to pay for it or not and whether it's economically feasible.
Mm-hmm. And speaking of hurricanes, I mean, what is covered with respect to water versus wind, and how to even distinguish the two damage?
Yeah, that was a big thing back in New Orleans, when they had that claim, because rising, typically, wind is going to be wind-driven rain, right? So you'll know when your glass is shattering on the second floor that is wind-driven rain. When flood waters are coming up and it's coming up through the first floor, that's going to be your flood. And typically, a lot of people are not aware of this. There are sublimits in a lot of these policies. They're buying the wind in that case, but a lot of them are just using the NFIP, which has very minimal coverage, which is the government-funded program, which is running into its own financial issues. And if the government would have shut down, there would have been a moratorium on any new writings there, which would have had a dramatic effect on real estate closings and all the transactions that you and a lot of the real estate world would have been working on. So we don't realize how important it is to the flow of transactions in real estate. But does that answer your question, the difference between the two?
Well, yeah, because my understanding is that just flooding water coming from, I guess, the first level is typically either excluded or not covered to the same extent as wind damage, and then water coming through a broken window.
If you're living in Florida and you've got 10-foot surge, that's going to be flood. If you've got the wind, that's going to take the structure down. A flood's not going to do that, bottom down or top down. So that's kind of the difference between the two.
Yep. I guess one of our last questions here, being in California, certain lenders require earthquake insurance, but earthquake insurance extremely costly, and the coverage is not that robust. Aside from what the lenders are requiring, and most of it is based on seismic studies, and if your property gets a certain score, if you're above that score, then the lenders are going to require it based on location, structure, year built, type of materials. What's just your overall feeling about earthquake insurance, the risk reward, or I should say cost benefit of earthquake insurance?
You've got to look at it, where are the zones, where's the location, what is the cost associated with it, and what capacity is available right now to be able to want to insure that at the right number. It's getting to the point where earthquake, windstorm, in Florida, for example, the windstorm load could be 80-85% of the premium, right? So earthquake, similar if you need to insure that. There are structured risk solutions as it relates to earthquake, using one as an example, because if you do have an earthquake, right, you've got damage to the structure, but more importantly, you've got business interruption issues to deal with. And that's really the crux of it in many cases. And getting those claims settled, it's an accounting function. It could take you the better part of 2 years to get something like that resolved in litigation and so on with the carriers. There are other structured solutions that a lot of clients are looking at right now as it relates to earthquake, or wind or anything that's easily monitored. And I don't know if you've heard of the term parametric insurance.
I haven't.
Parametric insurance, it basically responds to the event, okay, itself. So if you have, like in Ojai, that earthquake registered at 5.0, and I had an office building that was within a mile of that, let's just say, and there are third-party governmental agencies that will monitor and register what that is. Parametric insurance is basically an insurance policy that says, okay, if it registers in this zone 5.0 or greater, okay, and it's a bit more complicated, but I'll just give you the high level, and you want to buy $5 million worth of insurance, if it registers 5.0, I don't care if you had any damage or not, you get $5 million. It's going to a casino.
Wow.
And it basically, if there's no physical loss, that's not the driver. It's really the number you're picking. And if it affects revenue, there's so many times that there could be an earthquake. The road is cracked. Nobody can get in, can get out. I can't, my retail center can't do any business, but I had no physical damage, so I can't put a claim in. What do I do?
Interesting.
So these are structured products. There's other ones too, but if we try to get into it, we'd need a lot more detail. But high level, this is one that's easy enough to understand. So the word parametric is something that you'll be hearing more about. It's been around for a while, but I think it's becoming more prevalent right now because of these situations. So those are the kind of alternatives that I think people need to be made aware of.
Yeah.
Unfortunately, the majority of the brokerage world doesn't understand it, and they don't know how to procure it. So those are the kind of things that I think are important. And a lot of them are through European carriers. So having that access, even though they have presence here in the United States, those are the kind of things that we can talk about in lieu of what if I have an earthquake, but I can't get my insurance paid.
Yeah. And I guess the last type of insurance that comes up is terrorism insurance, where lenders will require terrorism insurance, and we'll argue that this is not a high profile building. How often do you get into terrorism insurance, and how does an insurance company even determine whether an event was terrorism? Like if obviously we're seeing a rise in mass shootings, and is that terrorism? Is it not terrorism? So how is that all covered?
Yeah, I mean, it's a very gray area, but typically there are two types of, there's the domestic issue, and then there's, the global terrorism as we know it.
Yeah.
But typically we have the ability to satisfy the carriers, and the property underwriters will typically put that in there. It's not super costly unless we're dealing with an Empire State Building or something of that magnitude. Sure. So I don't think terrorism has really become an issue for us. If there are particular lenders, we can talk to them, we can negotiate with them. And there are other terrorism policies that can drill down and provide what's necessary, but none of them are overly obtrusive right now. I don't think the pricing is becoming an issue. It hasn't been a deal breaker to date. Yeah.
So I guess as we conclude here, where we'll see if the volume of transactions pick up here in the fourth quarter or into 24, and with insurance being one of the key focal points of our clients' underwriting decisions. Any sort of last words or advice that you can give our clients who are underwriting and evaluating transactions and insurance being such a driving factor?
Yeah, I mean, the first thing is, we look at residential versus commercial, right? Office, retail versus apartments. Apartments, we can't pass that through. The market will bear what the market will bear in terms of rents. On commercial, retail / office, you can pass that through your CAM charges. I would check those leases in detail. Make sure, a lot of them have caps on what you can pass through as it relates to CAM charges. We know insurance has been going up at a very, very hefty clip on an annual basis. I'm not suggesting you can do something that's going to hurt market, but having that flexibility is very important. So, one, I would definitely make sure I go check those leases. Two, I try to consolidate and make sure that if I do have a portfolio, that property that I'm going to buy, I have the ability under a current program to be able to roll that in. If I have a large enough program, large enough spread of risk, it's going to give me a dramatic advantage over my competitors in the marketplace. And thirdly, making sure that you have the right time of year that you're renewing. You don't want to renew in the middle of August, the middle of September, in the middle of wildfire season, hurricane season. You also don't want to go too far out where there's less capacity available after reinsurance treaties are negotiated, which is typically in January or June. So a sweet spot is typically that March, April time.
But if you're in that cycle, how do you get out of that cycle? I have clients whose renewal is September 1st.
Well, what you do is come September 1st, you try to do an 18-month policy, or you do an extension till May, and then you go ahead and do a renewal. It's risky right now in this marketplace because once you lock in premium, could it go up again 6 months later? Yeah, but you've got to get out of that cycle. You have to break it because it's not helping any, especially if you're coming off a year where you're in California and we had this major hurricane here in Florida. That's going to affect your pricing, believe it or not, because the reinsurers are taking it on the chin and they're going to push that down to everybody. So those are the kind of things, high level. I'd also look at some of these structured solutions. If the portfolio is big enough, if your rate for the first 10 million is heavy, which is where the heaviest premium is going to be, there are alternatives if you're willing to take some risk and you don't necessarily have to go the captive route, which does have its own set of expenses and exposure too. So those are the kind of things, again, and making sure you, which we touched on before, proactively negotiate with the lender and make sure that they're aware that you're going to take a little more risk, whether it's on the deductible or you're going to use the risk model to justify why you're going to insure less on the upside. So those are kind of high level things that I would take a look at.
Well, that's all very helpful. I know you've always been helpful and instructive for my clients when it comes to insurance issues. And so I just want to thank you for always being available and for coming on to my podcast. I know my audience will greatly benefit and learn something about insurance. So thank you, Michael.
Andrew, I just tell you one parting comment. We've dealt with so many transactions, so many attorneys, and I haven't met any that have gotten into the depth of questions that you have. So I will tell you, not that this is a comment that I feel obligated to make, but it's something I should say is whoever you are representing is very fortunate that you do have the breadth of experience and knowledge in this area, at least to know what questions to ask. So I'm glad I could help, and I'm thankful for giving me the opportunity to be on the podcast.
I appreciate it. Now I have to pay for the next time we play golf. Well, thank you, Michael, and I appreciate you coming on the show.
All right, we'll talk soon. Thanks again.
Take care. Thank you.
Bye.
You've been listening to Real Talk, Real Estate Discussions with Andrew Kirsh. You can catch prior episodes at sklarkirsh.com and on YouTube, LinkedIn, Apple Podcasts, Spotify, Google Podcasts, and more. Thank you for your positive reviews, comments, and for sharing the show with others.